If you're watching this video, that means you know investing is important, but exactly how should we invest? How much should you have in stocks? How much should you have in bonds? And why have we been getting this wrong for decades? Let's go ahead and break it down. When we talk about how much you should invest, right, between stocks and bonds, this is called asset allocation. That is the big fancy term for it, and it is one of the absolute most important things when it comes to investing, because 90% of your returns is going to be a result of asset allocation. Yeah, 90%. So you have to get this right. You could say 90% of your stock should be in stock, 90% of your money should be in stocks and 10% in bonds, or the other way around. Whatever you do is going to have a major impact on how much money you have at the end of the day. Now, there are a few ways that you can come up with this. There is something called a rule of thumb, right? Called the rule of 120. What this means is you take 120 minus your current age. That's going to tell you how much you should have in stocks versus bonds. So for example, let's say we take 120, let's say you're 30, that means that 90% of your money should be in stocks and 10% should be in bonds. Now, think about that. That is based on your age. So everybody's going to have a different number. And the older you get, the more those numbers are going to change, which is the way it is supposed to work, or at least the way we thought it was supposed to work. And as you get closer to retirement, the less you should have in stocks, the more you should have in bonds. And the reason for that is to protect against the market failing or falling apart right as you get to retirement. That's the last thing you want to do. You've made $2 million, you made $1 million, and then you lose half of it the day before you retire or in the year of retirement. That's absolutely going to change how you operate. So this asset allocation, this changing of your portfolio, was the way to protect against it. And the golden ratio, if you will, when it comes to investing has been getting yourself to a 60-40 portfolio. So right now, let's say I'm at 90-10, right? I'm in my 30s, I'm 90-10, I'm making money, everything's fine. And then as I get older, I go down to 60-40, I stay at 60-40 for the rest of my life. For decades, researchers have been saying you get to 60-40, you're good. That's enough growth, enough protection. Market can crash, you are still going to be fine. Get to 60-40 has been the gold standard. Researchers now said that it has not been right. It's not been right. According to a recent research study, I'm still struggling to reprogram my mind, I guess, around this, because they say that it's 100%. But you should have 100% of your money in stocks. And within that 100%, you should have 50% domestic, so that's 50% stocks in the US and 50% international. Now the good news, the good part of this is this can be done very, very easily. You can find 2 ETFs, okay? Get one from the US, get one that's international stocks, and just be done with it. Your portfolio can be extremely simple if that is what you want to do. And I am all for simplicity. And you guys know, my kids who are 5 and 3 at the time we're doing this video, they have 100% stocks. But that's the thing. They have 100% because they have forever, right? They can invest for the next 10 years or 20 years for that matter and still be really young, right? They can do that. Dad cannot, right? So they say that, again, 100% of your money should be in stocks, and they did millions of analysis here, and they said the average return for someone who did the 50% in US stocks, 50% in international, which is 100% stocks, they said the return was $1.0 million. 1.07, exactly, $1.07 million. For those who did the 60-40, they had $760,000. Okay, that's a big gap from 1.07 million to just 760,000. That is a very big difference. Now they did have one extra category here. These were called target date funds. That one had 810,000, so it's slightly better. But again, a $200,000 to $300,000 gap. That's a lot of money. And so what are the pros and the cons of being 100% in stocks? Well, one part of it is you are more likely to make more money. We know that stocks generally outperform bonds. I like to say that stocks are the pedals on a bike and bonds are the brakes. You want to go fast, you want your money to grow, you want things to be exciting, you got the pedals, right? And if you fall, so what? It's easier when you are younger to get up, right? You got a bruise, you're limping a little bit. You know, if you're in your 20s, you're fine. If you're my kids, you're fine. You forgot the whole thing happened. Once you start getting up there, it hurts a lot more, right? You fall down above 50, 60, 70 years of age, bruh, that's gonna be an event, right? That's not something where you can just, hey, I fell, everything was fine. It's gonna hurt a lot more. So you have more breaks. So you can balance and get to your journey, right? If you're riding a bike, to financial freedom. Well, if you are doing the 100% stocks, Warren Buffett sort of agrees with you. And that's because he has said for years now that, hey, when he goes, put 90% of his money in stock and keep 10% in cash and bonds. Now, I thought that was aggressive. I was like, hey, you worth, what, $100 billion? You can do that. I may not be able to do that. And here's the thing. Should you change all of your money and just go to 100% stocks and let it ride? The research says yes. However, there is a bit of psychology and there is a bit of your emotions that play into this. Your emotions don't do math. However, they have caused people to make some very serious mistakes, myself included, right? I'm not immune to listening to how I feel about things versus looking at the data. So one example, everybody thought and felt that it was a recession in 2023. It wasn't, right? Some people invested on that gut feeling, even though it didn't work. Go back to 2020 and just search your Facebook timeline and your Facebook group right now and see how many people said they were selling everything in 2020 and getting out of the stock market because they saw their 401k go down. Remember that. Okay, remember how many people said that at that point in time, all to find out that the stock market did gain in 2020. The stock market was up at the end of 2020, though people sold. So imagine having all of your money in stocks and seeing you look at your account. One day everything's great, you had $1 million in there, and then within 30 days, within 45 days, you went from $1 million to 800,000. Can you sit there and take that with a straight face? Can you do that and not move? If yes is your answer, then maybe you can do 100% stocks and just be fine. Everybody else may not be able to do that, and you should invest accordingly to how you are going to react to that. Now for me, I think 85%, 15% is where I've been recently, and I like that. I may stay there, right? It is close enough where I can get a bit of gain, but also not so aggressive where I'm going to freak out if the market falls. Now, I'm also in my 30s. Maybe this will change as I get older, but I want to make sure I'm capturing as much gain as possible, right? And the best way to do that is to have more in stocks. But the main thing is you have got to make sure that this fits for you. I'm also going to make sure that I put the research study in the comment section too, so that you can look at it and peruse, take it to your financial advisor or whomever, so they can look at it too. Because again, for me, for someone who has studied this, I got degrees in this, I obviously read and write books about this. This is, I'm not gonna say earth shattering, but this is rough. Okay, because it's not the thing that we have been accustomed to doing and thinking about for decades. So I would love to know what you think. Also, if you want to figure out what to invest in, right? We know how, we know what those percentages are, but if you know what to invest in, then you want to check out these videos right here.